You're watching prices climb on almost everything. Groceries cost more, and the small items you never used to think about suddenly demand more of your budget. The pressure builds as rent increases and gas prices fluctuate. Even when you cut back to be responsible with your money, you still lose ground. You keep hearing the same explanation. The Federal Reserve is fighting inflation, but it does not feel like it is working. Prices remain high, and your paycheck has not kept up with the cost of living. There is a disconnect between the reports you hear and the bills you pay. It feels like the institutions in charge are utilizing methods that simply do not reach your daily life. The Fed uses several different tools to address rising prices. Most people are familiar with interest rates, which the Fed can raise or lower to influence how much people spend. There is a second lever that moves the economy, often before an official rate change even happens. It operates based on a concept called expectations. The mechanism is simple. What people believe will happen next changes their behavior today, which in turn changes the actual outcome of the economy. Steering these beliefs is an intentional strategy. It is one of the most effective tools the Fed has for steering the economy, though it is rarely discussed outside of professional circles. For a long time, I treated Federal Reserve announcements as background noise. They felt like technical updates meant for Wall Street, not for someone managing a grocery budget. That changed when I watched the Fed chair describe a new economic plan in a press conference. Immediately after the announcement, savings yields began to rise, while borrowing became more expensive. A yield is the interest or return you receive on a savings account or investment. No policies had officially changed yet. The financial system reacted entirely to the message itself. These announcements are not just noise, they are triggers. They alter the financial landscape for everyone, often months before a new interest rate is set. The broader financial system reacts to every public statement about inflation. Mortgage rates, savings yields, and stock prices all shift based on the Fed's language. There are two indicators you can watch for. If the Fed says they are determined to keep tightening, borrowing costs are likely to stay high. Tightening occurs when the Fed raises rates to make borrowing more expensive, which slows down spending to help lower inflation. On the other hand, if they suggest they are getting ready to ease up, borrowing conditions may improve soon. Easing is when the Fed lowers rates to make borrowing cheaper, which encourages more spending. You can track these shifts with a simple habit. After a Fed meeting, spend 2 minutes reading a summary to see if they changed rates and if their language suggests more changes are coming. This gives you a head start. You can see the direction of your future bills, loan offers, or savings rates before they actually arrive. Understanding these expectations helps you identify the direction of the economy earlier. It allows you to move from reacting to inflation to preparing for it, helping you make more informed moves with your money. How does the Federal Reserve actually go about fighting inflation? Let's make this simple. Their best-known tool is the federal funds rate. The federal funds rate is simply a target for the short-term interest rates that banks charge each other for overnight loans. You will never actually pay that exact rate yourself, but this hidden number influences almost every other rate across the economy. When the central target shifts upward, the cost of mortgages, auto loans, and credit cards moves right along with it. The consequence? Borrowing money simply becomes a lot more expensive. To fix an overheated economy, the central bank restricts access to capital, making money harder to get. When those borrowing costs go up, the effects spill out of the banking sector and into everyday life. Faced with higher bills, people and businesses usually have to slow down their spending. They delay buying homes, hold off on purchasing new cars, or pause corporate expansion plans. This chart shows exactly how that math plays out. If a standard loan rate moves from roughly 4% up to roughly 7%, the required monthly payment on that exact same big purchase jumps a lot. Suddenly, fewer people can comfortably afford what they could buy just a few months prior. That drop in affordability cools down overall demand and takes the pressure off consumer prices. Applying direct financial pressure to everyday purchases is exactly how they cool that part of the economy. That there is a hidden mechanism in this strategy. It is what happens before the official interest rate makes any move at all. The Fed talks. They release policy statements, give public speeches, and share their internal economic projections. This diagram illustrates a strategy economists call forward guidance. Forward guidance is the practice of communicating future monetary policy intentions to the public so markets can prepare. It relies on a simple psychological principle. Expectations about the future change behavior today. If banks, investors, businesses, and consumers believe borrowing is going to stay expensive, they start adjusting right away. The mere belief that financial pain is coming is often enough to trigger immediate economic pullbacks. Some lenders reprice their loans immediately, certain businesses pull back on hiring, and households delay major purchases. It doesn't work perfectly. Now that you understand that dual strategy, let me show you what most people should stop doing when the Fed enters tightening mode. Watch this digital display. That violent red spike is exactly what it feels like when the Federal Reserve actively steps in to fight inflation. It triggers an immediate emotional response that feels incredibly smart in the moment, but quietly drains your bank account over time. The first common misstep is panic reacting to dramatic interest rate headlines. Every time the Fed raises rates or even hints at it, headlines get dramatic. And when people see those headlines, they do impulsive things. People sell off their investments the second the market dips. They rush into buying a house because they fear rates will climb even higher, or they pull all their money out and sit on cash, waiting for the dust to settle. The issue here is how financial news is engineered. Headlines are designed to grab your attention, not to guide your financial strategy. The Fed usually communicates its changes in careful, pre-planned steps. But the news coverage can make every single meeting feel like a turning point. People who react to the loudest headline often lock in losses they did not need to take or rush into decisions at the worst possible moment. Look at what happens when we pull back from that daily panic. That extreme red line shrinks down until it's just a microscopic bump on a massive, flowing, multi-month timeline. The better move is to focus on the overall direction the Fed is heading, not what happened in a single Tuesday afternoon announcement. Treating a long-term economic shift like a sudden daily emergency is the absolute fastest way to secretly sabotage your own long-term wealth. The second miscalculation happens when taking on large, expensive new debt based on the assumption that interest rates will quickly drop back down. When rates rise, a lot of borrowers convince themselves it is purely temporary. They sign up for a variable rate loan, which is a loan where the interest rate fluctuates based on the broader market. Or they finance a massive purchase, operating on the logic that they can simply refinance a few months later when conditions improve. But rate cycles consistently last much longer than people expect. The Federal Reserve operates on a specific metric. They wait until inflation is strictly and undeniably under control. They completely ignore whether high rates are making consumers uncomfortable. If you take on expensive debt counting on a quick rate drop, you risk being trapped by unexpectedly high, restrictive payments for years, rather than a few short months. Before signing on to any major debt during a tightening cycle, periods where the Fed intentionally raises rates to slow down spending, you have to ask a simple mathematical question. Does this payment fit the budget at today's current rate? If the answer is no, it is too dangerous to sign for. The third trap is the false belief that the Fed directly and instantly controls all consumer prices and interest rates. Some people hear about a Fed announcement and expect instant, sweeping changes across the board. They look for immediate mortgage drops, credit card costs to flatline, or cheaper groceries next week. But the Fed mostly influences conditions indirectly, and different parts of your financial life can react on very different timelines. If you assume everything in the economy moves at the exact same time, you can make rushed decisions based on the wrong expectation. The better move is to treat the Fed as a signal about direction, not a promise about what every bill will do next month. The fourth misstep is settle, allowing a temporary rate cycle to rewrite your long-term financial plans. When borrowing becomes expensive and the market feels shaky, extreme thinking tends to take over. People decide they will never buy a home, or they indefinitely halt all their regular investments, assuming the entire system will stay exactly this restrictive for decades. But rate cycles do change. What feels permanent right now is very unlikely to stay exactly the same forever. There is a perceived safety in sitting back and waiting it out, but that ignores the actual long-term mathematical cost of missing out on years of compound growth and clear market opportunities. And the opportunities you avoid during a tough stretch may cost you more in the long run than the tough stretch itself. The thread connecting all four of these mistakes is the exact same human flaw. People either react far too quickly to short-term noise, or they pull back way too far in generalized fear. They let short-term conditions drive decisions that may affect them for years. To build wealth, you have to adopt a specific mindset. You must learn to think in long-term cycles, which is exactly how the Federal Reserve operates. Once you adopt this cyclical approach, it becomes entirely possible to protect and grow your money, regardless of whether interest rates are climbing up or trending down. And that is exactly what the action plan is about. Next, we will break down a step-by-step action plan to transition from understanding these traps to actually executing smarter, cycle-aligned financial moves. When the Federal Reserve actively tightens its monetary policy to fight inflation, the immediate effects ripple directly into your personal finances. The first defensive action you need to take is auditing your exposure. Pull up your credit card statements, loan documents, and any debt that carries a rate that adjusts over time. When the Fed raises rates, variable interest rates follow that upward trajectory, meaning existing debt quietly becomes more expensive. If you carry a high balance, you pay a compounding penalty. The balance stays the same, but the cost to service it accelerates each month. Cataloging the exact rates on every account you hold is the only way to identify your exposure and stop the financial bleeding before the economic cycle worsens. Rising rates do have a mechanical upside for anyone holding cash. Savings yields rise right alongside borrowing costs. Money sitting idle in a traditional regular savings account earns close to zero interest. In a high-rate environment, leaving cash there means you are giving up guaranteed returns. This bar chart compares the two options. The traditional account stays entirely flat, while the high-yield account, offered by many banks, scales upward to match the current rate environment. Moving these funds takes a few minutes on a mobile app, and the money remains completely liquid and easy to access. By simply relocating your cash, you turn the Fed's tightening cycle from a threat to your debt into a proactive earning tool for your savings. The Federal Reserve raises rates because making money expensive intentionally slows down the broader macroeconomic engine. A slower economy translates directly to tighter business budgets, delayed expansions, and far fewer job openings. Expanding your personal cash cushion is the primary buffer against that slowdown. Directing a small amount from each paycheck into an emergency fund gives you specific protection if your income is interrupted. You also need a strategy for your long-term automated investments while this slowdown is happening. When the market gets choppy, the natural instinct is to pause your contributions and wait for stability. Here on this scatter plot, we see why pausing hurts returns. By maintaining steady, automated contributions across both the peaks and the deep valleys, you average out your purchase price over the entirety of the cycle. A fully funded emergency cushion protects you from being forced to sell off assets to cover unexpected bills, which allows your automated investments to capitalize on market volatility safely. If you need to finance a major physical asset, like a home or a car, the direction of the macroeconomic trend dictates what you will pay. The Federal Reserve frequently uses forward guidance, which are public statements and signals about their future policy intentions, to manage expectations. Street-level lending conditions adjust directly on these signals. This diagram shows that relationship in real time. When the Fed signals that the tightening cycle is slowing down or nearing its end, the trend line for long-term loan terms begins to improve in the months that follow. Aligning your major purchases with the general direction of these trend lines secures better loan terms without requiring you to perfectly predict a market bottom. The national inflation average is a macroeconomic data point. It rarely matches the specific reality of your personal cost of living. Audit your actual consumer spending over the past several months. Look closely at your exact numbers for rent, groceries, utilities, and insurance. Isolating the exact categories where your costs have spiked the highest allows you to target your budget adjustments where they actually matter. You can offset those specific sector spikes with actionable micro-fixes. Switch a service provider, adjust an insurance plan, or drop an unused subscription. Shaving down those targeted expenses creates the necessary monthly liquidity to sustain your emergency fund and your automated investments. Rate cycles are entirely finite. Eventually, the Fed signals that inflation is under control and prepares to pivot toward policy easing. That turn creates highly specific financial opportunities. It opens a window to refinance existing debt at a lower rate, lock in better mortgage deal, and adjust your asset mix. By tracking the Fed's signals early, you're in position to move the moment lending conditions ease, while the general public is still reacting to old data. You know how higher rates cool the economy, how forward guidance steers lending, and how to utilize yields. Understanding these mechanical levers allows you to build a systemic wealth accumulation strategy out of a tightening cycle. If this made Fed decisions easier to understand, like the video so I know to make more of these. If someone you know is feeling squeezed by rising costs, send this to them. Comment your rate plan down below and subscribe. I post new videos every Tuesday, Thursday, and Sunday. I will see you in the next one.